It's radical transparency. Communication is the underpinning of that. I can remember, I think this is probably when I got Conor's cell phone number, in constant communication, daily, weekly basis with he and the other partners at Avidbank to make sure that we were able to navigate that effectively.
So the trick is to call Conor's cell phone number. If there's any problem, just call. It doesn't matter what time of day it is. Just call him.
I think we both had young kids that were crying in the background, but it works.
David, are you going to flash his cell number on the video screen
Yeah,
right here?
that's a good idea.
Go for it.
Search Party is sponsored by Avidbank, Boulay, Mayer Brown, Plexus Capital, and Oberle. The lead sponsor is Next Coast Legacy. Hello and welcome to Search Party. I'm David Snow, your host. And today we're joined by Chandos Mahon of Castle Capital, Conor Tidgwell of Avidbank, and Anthony Walker of Next Coast Legacy. Gentlemen, welcome to Search Party today. Great to have you here. Today we are going to be talking about a very important topic, which is the relationship between an ETA searcher turned CEO, the CEO of a lower middle market business, and his or her lender. This is a critical relationship that can impact the success of an investment. Some people might assume that if you spend a lot of time speaking to your lender over the course of an investment, that might be a bad sign, like bad things are happening and you got to work things out. But actually, it's also a sign that you are structuring the business in a way that is supportive of the business's growth, wherever it is on its growth cycle. We also have a great case study that we're going to get into. Conor and Chandos have worked together on a successful investment called Castle Tire that has exited and was successful. And throughout the course of that investment, let's just say that you two spent a lot of time with each other. Anthony Walker and his firm, Next Coast Legacy, have for years been backing ETA searchers as they acquire lower middle market businesses. And Anthony has a lot of insights into what's necessary for these businesses as they move through various stages of growth. Why don't we start first with a question for Chandos? Give us the headline as far as why it's important to maintain a close relationship and a working relationship with your lender over the course of an ETA investment.
First off, if you think about it, you're out buying a business, right? And maybe you're paying somewhere between 4.5, 5 times EBITDA. And you're bringing in your lender at 2 times that, so 2 turns of debt. That means your lender is providing 40% of the capital for your investment, right? And in the traditional search community, your investors are probably sub 15% on your cap table. So your lender is your largest investor. Avid was my largest partner in this deal. They have the largest percentage of my capital stack. The second point around this question is your business evolves. So what we bought in 2017 changed dramatically over the years. My needs of capital evolved with that. And rather than having these kind of random once a year interactions of, hey, how are things going? Bringing your debt partner in along for the ride on conversations as you evolve on a monthly basis gives them the insight of how you're doing. And so when I need to go back to the well and ask for more debt because I'm doing an acquisition or I'm doing a plant project, the conversation's a lot different than if it was the first time I engaged Conor in 12 months.
Question for Conor. I mentioned earlier the idea that some people might get the impression that if the sponsor of a lower middle market transaction is spending a lot of time over the course of that transaction, talking to the lender, reworking things, that's a bad sign. But in your case, you've had very successful partnerships that have changed in structure over the course of the life of the investment. Before we get to the Castle Tire case study, just give us your expert overview of why it can be healthy to have many different conversations with your lender over the course of a deal.
Ultimately, it centers around flexibility. And in order for lenders to be flexible, they should be fully up to speed with everything going on in the business and ahead of both growth strategies, maybe challenging times. In both cases, the more time we have to interact with our counterparties at the bank, with the borrower, with the board, the better solution we can probably provide. Conversely, if we get caught with a surprise and we're in a reactive mode, that's typically when lenders are less flexible. So frequent communication should be viewed as a really positive thing. Chandos touched on the trust factor. That's only going to build the relationship and the trust. We're trying to fill a solution and fill the needs of the business. That's really what we're here to do. In order to do that, it's got to come with that frequent communication well ahead of when those actions might take place. So we can put together a creative solution to, again, maybe get through a tough time or fill the needs of growth strategies. So it's imperative. It's probably the one thing I'd tell any searcher. It's the most important thing above all else is to make sure you're, communicating, being transparent and upfront with your lender, just like you will with your board. Talk with your lender about your plans for the upcoming year. And of course, if there's challenges up ahead.
As CEO, I want Conor to pick up the phone when I'm calling and excited about my phone call. I don't want him picking up the phone and be like, oh man, what kind of trouble is there now? Right. And if you only reserve your conversations for moments of issues, that's what Conor's going to do every time I call. Whereas if you're in a good cadence and maybe 7 out of 10 of your conversations are exciting about growth or new hires or challenges that you're overcoming, then the other 3 difficult conversations are just part of the relationship.
100%.
Anthony, you have backed many ETA searchers to acquire lower middle market businesses. What do you tell them about the relationship with the lender, especially considering that most of these people are first-time CEOs and have not previously acquired a business and certainly have not run a business in a leveraged environment?
Yeah, I think the earlier comment that your lender is often your largest investor, quote unquote, and a member of your capital stack is an extraordinarily important comment. That capital stack is also put in place at a static point when all of us collectively know, the least about the business. We'll know far more about that asset 2 months in, 6 months in, a year in. And as a result, your capital needs and that capital stack can change and it can evolve over time. And so developing a healthy relationship with that lender looks like open lines of communication. It means working with that sponsor to develop a clean and consistent financial reporting package that we can all leverage to run the business more efficiently and provide the necessary level of information and data for all of your constituents to be able to engage with the company and add resources and perspective to the operations of the business. It also means leading with bad news first. Do not bury information, particularly when you're working with a lender. Lenders are your partner, and all of your partners can only be as helpful as the information that you provide. One way or another, that information is likely to come out. And so trying to obfuscate or hide or disguise kind of the true performance of the business is something you absolutely should not do. And the earlier that you can provide insight into challenges that you're having, I think the better relationship and the more trust that you build with a lending partner that carries you throughout the holes. And ultimately when things kind of get better. Conor and I have lived this in some deals that we've had together whereby things were not so great, and being out in front of the issue ultimately creates a stronger bond and more confidence from the lender group, such that when things are going well and you're in a much better position, that partner is still as excited about working with you as they were the day that you acquired the company together.
I really can't think of a search business that we've been involved in the last 11 years where we haven't done some kind of follow-on financings. We're usually coming in at the time of acquisition. That's the initial use of proceeds. Thereafter, just as the business will go through a fairly transformative change, so will the needs of that business and the debt needs of that business. For us, follow-on financing includes, just to name a few, add-on acquisitions, dividend recaps. We understand kind of the waterfall economics that a searcher is working with and how important that can be. Growth CapEx. There's some really creative solutions out there, so they're paying less out of cash and leveraging debt. Working capital needs, seller note payments, earn-out payments. So these are good for all of us, right? These are proceeds where the borrower can leverage pretty cheap cost of capital and it's non-dilutive. And then for us, we're happy to layer on good loans, good outstandings that generate more interest income so long as the covenants and the metrics support it.
Anthony, are searchers that you work with ever surprised at the number of times that they might need to go back to their lender? Or are they going into these investments aware that there might be things like a dividend recap and some other moments where taking a fresh look at the debt structure is warranted?
Increasingly in the deals that we are doing, we're encouraging searchers to build out not just a base case, a downside case, and an upside valuation model. We're also encouraging them to build out a recap case. And typically that's a scenario where you take less debt than the business can theoretically support at the time of acquisition, with a view that once we're a year in and we have confidence that the business is stable, the recurring cash flows that we all thought were there are still indeed there, we can go and put more leverage on the business. Conor and team actually just did that for us with another deal that we're invested in. There are also situations where the cap stack doesn't change, but maybe the covenants do. I'm recalling a situation where we all kind of sat around a board table and the lender happened to be a board observer for the business. And we were discussing the limitations of growth because we needed to hire extraordinarily aggressively to support kind of growth in year 2, year 3, with very good line of sight from a contracting standpoint that growth was going to be there. But significant investment was going to have us tripping our EBITDA covenant because there's a timing gap between when that revenue starts to produce and when that expense hits the P&L. And in this situation, it's a great problem to have. This all benefits us over the long term. And the lender kind of raised their hand and said, hey, why are we talking about constraints here? Like, what does the business need? Is this in the best interest of all of us going forward? And isn't the right decision to relax the covenants in the interest of pursuing that growth, right? And that's a very healthy conversation that benefits all of the capital holders. But again, there was a covenant that was put in place early on in the investment at a static point. But as things evolved, as all of us were able to gain confidence that this was the right strategic decision, there was flexibility on the behalf of the lender to make that adjustment to the structure that was originally put in place. That only happens if you've got a good relationship, if you're transparent with information, and everyone credibly can say around the table that this is the right long-term decision for all of us involved, and let's go and do that in the interest of making this a better investment.
That's a great point, Anthony. It's not just the follow-on financing, it's other amendments to the credit agreement to, again, fill the needs of the business. And you nailed it, I think. Flexibility around covenant calculations, whether it's carving out an earn-out payment or a dividend, subject to maybe if they're sitting on a bunch of excess liquidity, but then the covenant is somehow getting tripped. Like, we don't look at that in a vacuum. Really good point.
Let's take a quick break to learn about a financial and wealth advisory firm that you should consider if you want to succeed in the entrepreneurship-through-acquisition market, Boulé. Since 2005, Boulé has been committed to the search fund ecosystem, working with hundreds of ETA entrepreneurs across North America and Europe. Its unique tenure in the ecosystem means Boulé are uniquely positioned to partner with you across the entire life cycle of the ETA process. Even before the LOI is signed, Boulé is your trusted partner, offering guidance and discussion points as you evaluate an opportunity. Boulé can lead your quality of earnings due diligence, giving you and your investors confidence that you're buying what you agreed to buy. Post-acquisition, Boulé remains at your side with assurance readiness services and assisting with financial and tax reporting or other consulting needs. Wherever you want to go with an investment, the friendly, trusted advisors at Boulé will help you get there. Look for commentary from Boulé experts in coming episodes of Search Party. Okay, now back to the episode. Chandos, maybe you can just give us your own ETA journey. You are an ETA searcher. You've exited a business. When you started out, what were you looking for? What did you find that you liked in the tire business? And then where did you go from there?
I started my ETA search in 2015. I can't believe it's already been 10 years. Waste services always fascinated me. You know, whether you're rich or poor, we're booming or busting, waste is an essential need. The industry itself was really founded in the 80s and 90s. So there were a lot of these interesting companies that have these founder-led companies that are baby boomers in their 60s, 70s. It fits the search model pretty well in terms of target type. If I could find a good business and make a good return and also do something interesting and good for the environment, then fantastic. It's a double win. I started my search in 2015. 3 months in, came across this tire business and absolutely fell in love with it. And also felt kind of like a rock star that 3 months in, I'm already getting to a deal that I'm, under LOI ready to close. And then it just absolutely blew up. And it just blew up because I was inexperienced and I didn't have a really good LOI that addressed the needs of my seller, the needs of my investors, as well as mine. So put it to the side, kept searching, spent 12 months in the waste space, started to move on to other industries, circled back to this tire deal, and month 18 got it going again. And fortunately was able to close it. So we closed in March of 2017. It was a traditional cap table with many of the folks out there, whether it's Trilogy, Anacapa, David Dotson, and then Avidbank was our lending partner in the deal. We held the company for 7 years. It was a long hold. It was a good run. Through the process, we survived COVID. We ended up doing a total of 10 acquisitions. Acquisitions was an important part of our growth strategy, but equally important, we also did two other things. We figured out how to really bring tremendous amount of focus to the one or two KPIs that had the most operating leverage, which allowed us to maximize our margin. And then we also figured out if we invest into some capital projects, we could really accelerate our profitability with the existing volume. Maybe take a step back, high level in terms of what the business does. If you and I go get our tires changed on our car, we'll go to a tire retailer, someone like Walmart or Discount Tires or Les Schwab, and you're paying $500-600 for your new tires. On the invoice, they'll probably charge you $5 or $6 as a disposal fee on a per tire basis. And then as a consumer, that's the end of it for you, right? And you don't really think about what's next. For the retail store that you just went to, they then have to contract with a service provider like Castle Tire. We charge them a fee to pick up their tire waste. We bring it back to one of our plants where we then sort it. We process, grind it up into various types of materials, and then sell that material back into different kinds of markets, hopefully to recycle it. Over the course of 7 years, we grew it to where we were processing about a little over 50,000 tires a day. Market-wise in the US, we generate about 350 million tires a year that need to get disposed. So we were picking up maybe a little over 15 million of those, so about 5-6% of the market. It was a good business. Ended up selling it to a strategic in February of 2024. We're on track to drive about a little over a 5x MOIC net back to the investors. It was a good outcome for all of us.
It sounds like at the outset, you already knew that there would be add-on acquisitions, tuck-in acquisitions. Conor, when you are talking to a sponsor about a deal that is definitely going to include add-ons, do you take a different underwriting approach? Do you assume that there's going to be multiple changes to the debt structure as these add-ons take place?
I'd say yes and no. At the end of the day, we are underwriting to the existing business. We can't predict the future. However, we're certainly taking into account when we look at the projections, the base case projections, as Anthony alluded to, they'll oftentimes include these add-ons. So, we want to understand what are the assumptions around those, the timing of those. Sometimes we'll put forth a delayed draw term loan at the outset, which is a facility that's put in place that they could draw on for these tuck-ins. Sometimes that's more of an ad hoc approach, which is what Chandos and I underwent during his investment. Whatever our initial term loan is or commitment amount is, we do have a max hold size of 20 million. So we're always transparent with our borrowers, want to make sure that they can, grow within those constraints.
So walk us through one of the debt restructurings that took place as a result of an add-on. What was the sequence?
Chandos was really good about, again, getting ahead of these. You always want to come prepared, and he did. We're looking at the add-on just like you would the initial acquisition. So we're going to be centered around quality of earnings. What's the pro forma EBITDA that's going to be layered onto this business? What are the ins and outs in terms of seller salaries going away? Do you have to make additional hires? Are you assuming synergies? What's integration going to look like? So we're asking all the typical questions that you would for the initial acquisition. And how does that look against all these covenants? We got to get pretty granular and make sure this makes sense.
When Conor first underwrote our deal, when we bought in 2017, we brought on about 2.5 times debt. That's what we were comfortable with. If we had some good or bad months, we weren't going to trip any covenants. Our debt to EBITDA covenant was around 2.5 times. So we had some headroom. About 18 months in, as we started thinking about the add-on acquisitions, there was one where we knew that it would push us right to 2.5 on day one. The last thing you want to do as a CEO and you submit your monthly reporting is, if your covenant's 2.5, your report says 2.49. It's like, come on, right? And it's also a stressful situation if you're at the edge of your covenant reporting, right? We flagged that early on that said, hey, if we do this, we add another, call it $1 million of debt, we're going to just be on the edge. So we've demonstrated 18 months. We have a good track record. We now have our arms wrapped around the business. We understand the free cash flow. We have a good projection going forward. Can we expand our debt to EBITDA capacity to 3x? That way, when I close on this extension at 2.5, I know I have some headroom in case I have a bad month.
It makes no sense to leave the lender with no wiggle room on covenants. That's just not a realistic scenario. So we're looking for probably a half turn at least of cushion on these covenants. And we're talking about a max senior funded leverage ratio and a minimum fixed charge coverage ratio. So it's not that hard to pro forma those and project those out. Want to make sure that the math works. More from like a qualitative standpoint, want to make sure it's an add-on that makes sense for the business. You always start with numbers and make sure there's adequate cushion out of the gate.
Connor, maybe a follow-up to that. What's the appropriate or a reasonable time from initial acquisition or the initial funding of your debt for a search entrepreneur to come back with what they view as an attractive M&A opportunity? I can imagine that the conversation is very different at 3 months versus the 18 months that's being referenced here.
Yeah, it's fairly few and far between, Anthony, in the first, even call it 12 months post-acquisition, where we get a lot of add-on activity. And I think you as a board member and investor would probably agree with that approach. We can diligence the heck out of these things, and we do, but the reality is you don't really know what you fully have until you're in the seat. Obviously, 12 months under your belt, you have audited financials. At that point, it's just a much more robust, sophisticated, professionalized business where, forget the numbers for a second, we're just way more comfortable with the business, the management team, et cetera. So it's a good point. Not saying we've never done it. I think there's some situations where it's, hey, we have this initial acquisition and there's a couple right thereafter that we feel really, really good about. We have line of sight into. In that case, we're basically underwriting to those, and that's where a DDTL might make sense. But 9 out of 10 times, I think year one, it's, hey, let's pump the brakes and make sure this is what we bought into.
What I love about this case study, and Chad, as you alluded to it, is that you waited 18 months and you waited until you had good visibility into the cash flow dynamics of the business and some confidence that you had your arms around it. We get, as you might imagine, a lot of searchers that want to pursue straight out of the gate kind of this multi-acquisition roll-up strategy. And I think you both kind of hit on a couple of variables or considerations to think about if you're considering that path. One is, the least about the business that you ever will on day one. And so your confidence is going to increase in the recurring revenue and the consistency of the cash flows as you go through the hold. That will inform greater confidence in pursuing M&A. But then secondarily, it's just how realistic is it to think that this is financeable and that a lender is going to get behind very quickly, you kind of rolling off 4 or 5 acquisitions in the span of 12 months. And that limitation of capital, if not provided from your equity holders, can be a real limitation to you hitting your growth targets. But it starts, I think, with the baseline of, do you have comfort and confidence in the first acquisition that you made, in the base asset, the platform that you're then going to bolt on, is, in your case, 10 additional acquisitions onto?
My base case for the initial acquisition still needed to be a good outcome if we made 0 acquisitions. At least in the search community, you don't want to get yourself into this idea where your value added is only through add-on acquisitions. And if that's the case, maybe it's probably not the right fit for a search deal, right?
When you are speaking to your lender about making an add-on acquisition, you might need to expand the debt to EBITDA limits in anticipation of the add-on layering additional EBITDA into the company. So what is that conversation like?
I think what Conor and I did was we looked at the base/downside case of the acquisition instead of the upside, and no synergies. Even if I was like 50% right with this add-on acquisition, can the business support the debt? And if the answer is yes, then I'm leaving myself enough room. I'm not betting the ranch on this deal. If I miss this add-on, I'm not all of a sudden in an environment where things are getting nasty.
You want to be as conservative as possible. You don't want to fluff these things up for your lender or for yourself or your board. You don't want to bake in a bunch of hypotheticals and synergies and all this stuff. Hopefully that happens. But you want to make sure, just at the very base level, the math works out and you're not hamstrung by the covenants.
I think there's an important signal that comes from a lender's willingness to provide covenant flexibility and or provide additional leverage in a transaction. And it's somewhat inherent to the reality that debt providers are cash flow based lenders that have an expectation of getting their money back, right? As an equity investor, I'm investing for upside that comes from growth, but I'm taking a different risk than a lender that is writing a much larger check is. And so their willingness to commit additional capital is a great signal of the viability of your business over a longer time horizon. It is also a very bad signal, or a red flag at minimum, if a lender is not willing to increase covenants, because that is a signal that they have a perception that the investment is much more risky.
Of the 10 acquisitions that you made, was there one where, in fact, the synergies did not quite materialize and you were grateful that you hadn't overextended yourself and that the underwriting assumption was, let's assume this thing doesn't work. we still don't want to be out over our skis. Was there a moment like that?
It was actually our first acquisition post-closing. We did an acquisition where we expanded into an entirely new state. Even though we were 18 months into it, we were still novices learning this business. And in hindsight, we definitely overpaid for it. The upside, is it helped spur our ability to demonstrate we can grow into new regions. There was definitely some added value later on in our operations where we were able to drive a much better exit for ourselves 5-6 years later because we were able to expand into this entirely new state. But man, for the first year, it was like, ooh, did we make the right decision here acquiring this add-on? It wasn't a dud. It definitely didn't hit where we wanted to performance-wise. But because we took a conservative approach on the underwriting piece of it, we weren't stressed with our ability to pay our loan.
You left yourself the cushion on the covenants to kind of weather that storm. I don't think we had a formal breach or anything, but it was...
Yeah, I'm proud to say over the 7 years, we did not have one breach.
There you go.
What happens if there is a breach? Do alarms go off? Can there be leveraged life after there's a breach?
The first question is, how did you not know about this? How did we not plan for this? Months, maybe quarters in advance of an actual breach. Ideally, we're teaming up as lender, our credit members, the board, certainly the management team, to come up with some kind of solution to get them through this tough period. That's so we can be flexible with, hey, the covenant's 3 times today. For 2 quarters, we're going to bump it up to 3.5 times. As maybe a large customer rolls off the books and gives you time to replenish that customer. Or maybe you have to make some painful decisions on OpEx. The last thing you want to do is take the keys to the business. I think people need to understand about lenders. Like, we don't want to get to that point just as much as they know.
In these situations, something has invariably gone wrong relative to the initial underwriting, and that happens. I think what's more important is, as you're thinking about the go-forward plan and the go-forward budget, ensuring that it's something that you think you can hit. It is one thing to have a covenant renegotiation or a credit amendment conversation. It's another thing to have subsequent credit amendment and covenant relaxation conversations. And that's when you really start to lose confidence with a lending partner. If you set an unachievable goal because you kind of just want to be beyond the conversation, in the situations where Conor and I have had to work through that, it's radical transparency. Communication is the underpinning of that. I can remember, I think this is probably when I got Conor's cell phone number, constant communication, daily, weekly basis with he and the other partners at Avidbank to make sure that we were able to navigate that situation and that challenge effectively.
So the trick is to call Conor's cell phone number. If there's any problem, just call. It doesn't matter what time of day it is. Just call him.
Call, text. I think we both had young kids that were crying in the background, but it works. It's fine.
David, are you going to flash his cell number on the video screen
Yeah,
right here?
that's a good idea. Yeah.
Go for it. I'll say this, Anthony. I think it obviously only strengthened our relationship. I mean, we probably didn't know each other individually overly well, maybe shook hands at a conference or something. But I mean, you see the true colors of everybody. When times are tough, it's really when you see the true colors. It was a better relationship. I'd call us, good friends. And certainly you're one of my first phone calls when I see you at a cap table. So that's been great.
100%. Yeah, totally agree.
Chandos, in addition to reworking the debt on the occasion of an add-on acquisition, were there other occasions to rework the debt that you explored with Conor, whether it was a dividend recap or some other situation?
We were about 5 years into this, and we did a pretty large CapEx project where we were building out a new plant. It was about $7 million of a CapEx spend. We thought it was going to increase our incremental EBITDA because of margin growth, of more efficiency, better recovery, better recycling. And it was going to take us 12 to 24 months to really start to realize the incremental benefits. And it was going to take us a year and a half to build it, at which we had to draw on the capital to start building now. So there was like this 3-year period where the benefit of the plant really didn't hit my income statement, but the debt was on my balance sheet. Conor was part of the process before I even got board approval, so I could make sure I was presenting a business plan that made sense to the board that I also had my bank buy-in on. That was a material change to our lending.
That was the big one. It was very creative. We call that a CapEx term loan, where essentially we would reimburse you for expenditures based on your receipts. Accomplish just a couple things for you. One, obviously you don't have to pay it out of cash flow. And then 2, any finance CapEx is carved out of the fixed charge coverage ratio. So it really allowed you to have that runway that you needed. But it's just an example of, here's the need. Let's be creative with the solution. That plant unlocked a ton more capacity, much more efficient, led you to your kind of the later innings to your successful exit.
Mhm. Yeah, it did.
If you were talking to a aspirational ETA searcher at a cocktail party or some kind of mixer, and they said, "Oh yeah, I got to get a loan. What should I know?" What would you say?
For those folks that are launching their search and they're starting to do industry ideation and they're starting to go through thesis development and reaching out to business owners, it's probably a good idea to start to get to know folks like Conor and his team and the other lenders in the search fund community proactively.
Yeah, I'd probably double down on Anthony's comment that the investors really get to know who you are through the process of your searching. They're really investing into you, right? And if you take that approach with the bank, your last 30 to 45 days before closing are extremely stressful, right? You're herding cats and you're trying to bring all this to close. You have a seller who's probably fatigued, who probably wants to maybe back out. You got counsel that are going head to head with the other counsel. The last thing you want to do is then bring a bank into the process at that stage. Start early, start before you even have a deal, and start building that relationship and bring them along for the ride. And they're part of how you evolve your investment thesis on that particular deal.
Conor Tidgwell of Avidbank, Anthony Walker of Next Coast Legacy, and Chandos Mahon of Castle Capital, formerly the CEO of Castle Tire. And I hope I can have all three of you back on a future episode.
Thanks, David.
Thanks, David.
Search Party is sponsored by Avidbank, Boulay, Mayer Brown, Plexus Capital, and Oberle. The lead sponsor is Next Coast Legacy.